welcome. You're watching Money 9. I'm Sakshi Batra, and on this show, we will discuss all about markets. Well, the markets are at record high levels, but where do they go from here is the question that we are going to be asking. Joining in is a very special guest with me. I have with me Mr. Siddharth Khemka, Vice President, Head of Research Retail at Motilal Oswal Financial Services on this edition of Market Masterclass. Mr. Khemka, thank you very much for taking out time for us. The markets are really celebrating this. We've already seen 55,000 getting climbed on the Sensex. And Nifty has also crossed that 16,500 mark. But the question everybody is asking is that will we see higher highs from here, or will the markets really take a pause?
They are all at record highs and they're consistently making new highs. So what basically we are looking at that the third wave is yet to have a big impact, at least in India. We are hearing that there is some issues in US. China is facing some trouble, but barring that, we have so far been able to see a lower number, at least in India, and not good, going out of control. On the plus side or positive side, we have seen the quarterly numbers, which the result season is almost to an end with just last 2 days of results remaining with us. The result season has been quite encouraging. So Q1 of last year was when the bulk of the lockdown happened. And for the Nifty universe, we did some rough calculations for the numbers, and it is grown at about 74% the net profit, roughly about on a Y-on-Y basis, which is marginally higher. So our expectation was somewhere around 70%, 16 and 70%.
Okay.
And if you look at the management commentaries with the quarterly result season, they're all pointing to a huge growth in demand, the growth in the business, and they're looking forward to that.
Absolutely, absolutely. And we do hope that there is no third wave, which actually poses as a hindrance because the markets are looking up, the business and the management commentary is definitely looking bullish. But for that overhang, we hope that does not really spoil the party right now. But the big question also one is asking is that, looking at the kind of shakeout that we had seen in the broader market space, in the underperformance in the past few trading sessions, one wants to know whether it's a distribution of sorts or is there a bigger correction in the offering? What's your view here? And for those who own these mid and small caps, what is the best way to use this kind of a sell-off or under pressure, underperformance that we're seeing to their advantage?
Yeah, Sakshi. So you rightly asked, what do investors do? So there are a lot of investors, especially on the retail side, who have entered the market in the last 1 year, and they've only seen the market going up. And in the long term, we have seen that generally the market doesn't move up in one direction. We do have marginal corrections in between, and those are basically, I would like to rather say that profit booking taking at the right time. If you look at the overall big picture, valuations does seem a bit on the higher side, a bit ahead of the fundamentals and as well as valuations. But we need to keep in mind that the fundamentals underlining valuations have also changed to the current environment. So on a low base, we are looking at much higher growth, and that is where what the valuations are trying to factor in. And after almost like 10, 11 years, we are seeing the corporate earnings growing at double-digit growth. So that is something which we have not seen in the recent past. Coming to the mid and small caps, the broader market, we had seen a sharp run-up, outperformance after 2-3 years. And after having seen such kind of run-up, I think it's a healthy correction. People are taking booking profits, and we would still believe that if one has a view of next 2 to 3 years, mid and small cap still would make money. And the near term or short term traders, they need to be tread carefully given a lot of variables that could impact in the near term. But I think for long term investors, the correction is an opportunity to accumulate good quality mid caps, small caps. And from next 2-3 years, we are seeing that a sharp improvement, recovery in the economy, and also accompanying with an underlying growth in the corporate earnings, which should support the valuations and the run up in a lot of these mid and small caps.
Absolutely understood that. Let's now talk about some of the sectors that have been buzzing. I want to start off with the IT space. It continues to be IT all the way in the market. Do you believe that IT sector is in a multi-year re-rating phase? Are you adding more weight to large or mid-cap IT stocks? And if at all, where exactly?
Yeah, so if you look at IT, they have been consistently reporting strong numbers quarter after quarter. Even this quarter, we have seen almost a consistent growth, much higher than expectation. You have almost 4 to 5% sequential revenue growth in US dollar terms for the
Mm.
overall space. And if you look at the mid cap, the tier two IT players, they have reported even higher, about more than 6% sequential growth in the US dollar revenue.
Mm.
And what is also interesting is that all most of the companies, they are reporting all-time high order wins, the big ticket orders, the overall order book that they are getting, and that is also helped by the fact that the pandemic and the consistent change in the global business environment has led to a lot of large corporates increasing their technology spend, and the people moving to digital cloud, and that is only helping Indian players. So I would say that the overall view on IT remains very positive, and we would continue to recommend that people look at IT as a 2 3 year story. In the near term, yes, some of the stocks would have run up, but compared to the overall market, IT still is comfortably valued. You
Mm.
have the bulk of companies having no corporate governance issue, the best of the balance sheets, and they have the one of the best, you can say, the payout ratios, be it in terms of dividend, be it in terms of buybacks, uh, similar the kind of dividends or payouts that these IT companies do. We don't even
Mm.
see in some of the consumer names, be it in HUL or Asian Paints. I'm not trying to compare, these two sectors are not comparable, but nonetheless is a sector which is growing, has all the ingredients which we want to look at in any corporate: very good balance sheet, good management, good track record, and the most important thing, growth. Now that the growth is there, valuations tend to chase where the growth is. So we
Correct.
would definitely be positive on IT. The preference obviously is within the large cap space. We like Infosys, followed by HCL Tech. And as I said, the mid cap or the tier two IT players, they are continuously outperforming. The only hitch is that they have moved up sharply and valuations are a bit on the higher side. So we need to tread carefully there. Only if one has a long term view, one can look at stocks like Emphasis, Mindtree, then Zensar, and some of the IT product companies. For example, we have the L&T Infotech, Tata Elxsi, and KPIT.
Okay, understood that. Two more pockets there. One is, what's your take on financials? There was a long period of underperformance. They are trying to now inch up higher when we talk about the Nifty Bank. But overall, would you say that, the asset quality fears may actually come to haunt them a little later? The retail book has had some pressures as far as the big large cap names have seen in Q1 as well. Your thoughts on the entire financials basket?
Yeah, Sakshi. So financials have been the backbone, or you can say the highest weighted sector in the index, and that has been as I said, the backbone of the equity market for the last several years.
Hmm.
However, if you look at the recent past, things have been a lot volatile. With the Before we had the demonetization, then we have the GST. Business, at least in the MSME segment, did have an impact, which led to resurgence in the slippages. So
Hmm.
again, the first lockdown and the second lockdown, we saw slippages again increasing across banks, and disbursements have been sluggish. The only good part is that the deposits have been healthy, and especially there is a shift from the slippages on the NPA side from corporates to the retail segment. So a lot of these retail focused banks, they are reporting higher slippages in terms of asset quality. Overall view, you can say in a way, is kind of marginally positive. You have to be very selective. There are players, at least in the largely focused on the corporate side, which are doing well, where we
Hmm.
believe that still there is a lot of room for growth. The NPA mess or issues of the past has now been dealt with. So you
Yeah.
have something like an ICICI Bank and SBI being our top picks within the overall banking space. With the broader, you can say, financial universe, life insurance is a space which has been doing well despite the challenging environment.
Yeah.
Some of the gold finance companies are doing well. given the challenging environment, a lot of people have resorted to uh, taking loans from their household gold, and that is what we are seeing in the business. And so some of the other financials which are doing okay, but this is where our preference would be within the banking and financial space.
Okay. And the other pocket I wanted to take your view on is the pharma space. Now, we have seen some companies, markets have actually reacted very differently to each of these numbers. Like, talk about Sun Pharma, talk about Dr. Reddy's. Recently, we've seen, like, Lupin come out with the earnings, or Aurobindo Pharma. There have been hits and misses both. There are some signs of, pricing pressures coming in as far as the US sales are concerned. With that respect, of course, they've had a very good run because of this COVID-19 theme. The entire healthcare basket has had a very good run. After this, the most of the theme has actually played out now. We are just fading out. We are ending the second wave now. We still are not sure about the third wave. And most of the vaccinations are now taking place. That is also increasing. Keeping that in mind, how are you looking at the entire pharma space?
So you rightly said, Sakshi, the space have been clearly divided between the companies which were fairly rewarded by the market on back of the results, and some of them have been severely punished. So if you
Hmm.
look at some of the key trends that have emerged, overall, if you see the pharma space have reported inline numbers. But if you see specific companies, companies which are focused on the US market, we have seen some pressure, especially in terms of growth, and a higher pressure in terms of realization in the US market, which has led to some margin erosion for some of the companies which are focused out of US. Uh,
Hmm.
Domestic focused, India focused companies, they have done reported decent numbers. One key, you can say, exception being Sun Pharma, which has reported strong numbers across geographies, be it US, be it India, and we have seen how market rewarded that. Some of the companies which have reported weak numbers, Lupin, we saw Oro Pharma yesterday, Dr. Reddy's earlier. They all reported weak numbers, and market have reacted accordingly. So coming to the overall view, yes, the sector had seen a sharp run up, and that is where even a slightest of miss in earnings is being punished. We would have to say that you be selective. Some of the API names are doing much better, be it a
Yeah.
DVs, be it the Laurus Labs. So some of them are doing very well. Gland Pharma, and some of the domestic focused names are doing very well. Overall, pharma, I think there is still room for growth. We have seen that post both the pandemics now, for the first one last year and the second one this year, the focus on healthcare space overall has only gone up. And globally, with more and more governments pledging more spending on healthcare, I see that demand for pharma products would only go up over the years. And this is where India is a key supplier of a lot of these formulations, at least in the third world countries where India has a big market share. In the developed market, also we are gaining share. We are taking away share from the Chinese market, and plus in the APIs, we are becoming a large player to deal with. So these are the opportunities, and I think we have seen a lot of these companies announcing capex, which would come on stream 1 year, 2 year hence, which would drive growth forward. So
Mm,
again,
okay.
here I think even in near term, bearing the some of the results disappointment, I think these would be opportunities to add some of the good quality names, and they should do well.
Okay, understood that. And lastly, I have to ask you, is there any space that you are saying that it's a complete avoid at this point in time? Valuations are stretched and this sector or this space has completely run up ahead. There are no more triggers that could actually, be there that one could track. And, for all those investors looking to enter at this point in time at 55,000 Sensex, at 16,500 Nifty, the best way to create a portfolio, what would that division be? How would you suggest them?
So, Sakshi, if you look at, if the economy is going to grow at double digit for this year and high single digit next year, so you would say that if the economy is doing such well, there would be hardly any sector which will not do well. So that is
Yeah.
very difficult to say some sector which is not going to do well.
Hmm.
Valuation wise, it's really a mixed bag. Even within good sectors, as I said, there are stocks which are either overvalued and not moving up, say within the consumer space or within the pharma space. So you would really have to go selective. You can't take a full basket of a sector and say that you have to avoid a sector altogether. So that's a difficult one to take. You have to take them individually. If someone were to build a portfolio now, I would say that because you are entering late, do it gradually over a period of time. Make use of the benefits of the falls in the market, like the one we saw the last week on Friday. This week midweek we saw a sudden crash. So use those crash to enter the market and don't get panicked. Build a portfolio for 2 3 years. Within If you look at for 2 3 year horizon, some of the sectors that we believe should do well: selective BFSI, selective auto, IT, we are very much positive. Pharma, healthcare space, we are very much positive. Some of the you can say the old or the industrial sectors, for example, capital goods, cement, metals. We believe there is still a lot of room for these sectors to do well. So you could build a
Okay.
diversified portfolio of stocks from these sectors. And as I said, you build it not in one day, but gradually over a period of time, and use any fall in the market as an opportunity to enter. That should make a
Absolutely.
strong portfolio for a retail investor.
Point well taken. Well, on that note, thank you very much, Mr. Khemka, for sharing with us all these wonderful insights on the
My
markets and the
pleasure. Thank
strategies
you.
that even new investors, first-time entrants can actually use as these opportunities. In the current market, which is already trading at a record high level, and the outlook on the various sectors that you've also spoken to us. Well, with that, we wrap up this edition of Market Masterclass. We'll keep getting you such excellent voices, experts who will tell you exactly what you need to do in the current market scenario as well. Thank you very much for tuning in. But for now, you need to also like and subscribe to our YouTube channel, and also hit that bell icon so that you can get notified whenever we add a new video. And stay tuned with us with all our social media handles, and also visit our website, money9.com, for much more on markets and on personal finance. Thanks for tuning in.